Hello, everyone, and welcome to Franz's Real Estate Facts, episode 19. I was on vacation last week in the beautiful Jersey Shore, staying at a beach house close to, 2 blocks from the beach, which was really awesome. And the Atlantic Ocean is really different from the Pacific Ocean, and Jersey beaches are super different from California beaches. So it was a really great, relaxing vacation. I had a really good time, took a vacation, and now I am back. And we are here today with Jason Batt, who is a certified financial planner and the owner and managing partner, I guess, of Open Door Financial, which is a financial planning company. And what we're going to talk about today is buying a house is expensive. Houses are expensive, kind
This
of
is true.
everywhere. And a lot of times people think about houses as like, okay, being expensive because you have to, I don't know, get a down payment together and all of that stuff. But houses are also expensive to maintain. Like roofs are expensive. All these other things are expensive. Taxes are expensive. HOA dues are expensive. And so what we're going to talk about is just what does it financially look like to be a homeowner, and what things should people think about, not just when they're going to buy a house and figuring out how to get a down payment and all of that, and also what sort of maintenance things should people think about when they're going to own a home. So I want to introduce Jason. Jason, thank you so much for being with us. I really appreciate your time. And we've talked and you've said that you're really busy. So I really appreciate you taking the time out of your day today to talk to us a little bit about money and houses.
Yeah, I
How did
appreciate
they
it.
kind of come together?
Thanks for having me, Frantz. Appreciate the time today. Yep.
Awesome. So I guess we can start at the beginning. So when somebody is looking to buy a house, right? Because everybody right now is lots of people are trying to buy houses. What financially should they really think about?
Well, I mean, what goes through my mind first is how are you going to get into it? And of course, most people go to the down payment. There are mortgages like a VA mortgage if you served in the military, or if your family of a military member that wouldn't require a down payment. I think prudently, as a financial planner, I like people to come in with a down payment. The rule of thumb, if you can, is to come down with 20%, which for many people is tough here in San Diego, considering how valuations of properties have skyrocketed. But the idea there is to give yourself some margin of safety. If you buy something, let's say you buy a $500,000 place, which is probably going to be a nice condo here in San Diego. But if you buy a $500,000 place, and let's say you did a VA loan and you did a 0% down payment, so $500,000 mortgage, $500,000 valuation of the place, and then if the market does turn down, you're going to be automatically underwater, meaning that you have more mortgage than value of your home. And so if your place is worth 500,000 in the real estate market suddenly went down 10%, the place is going to be valued underneath that, and therefore you have no options to sell. And preferably if you're buying a place, then in my opinion, I think you should plan on living there for at least 10 years, or if you're not going to live there personally, then have some other plan to make it a real estate investment property to create some passive income down the road. Those are my initial thoughts. Outside of that, you want to make sure that the mortgage is going to be affordable both now and in the future. Sometimes I see people get in trouble when they buy too much of a place. Their mortgage is already stretching them, and maybe they're in their 40s or maybe they're in their 50s, and they're both working and they could afford it in the moment. They can afford it right now, but if they want to retire in 10 years down the road, and let's say they got a 30-year mortgage, well, they're still going to have 20 years left on that mortgage when they do retire. What's their financial picture going to look like when they retire? So sometimes people buy too much of a place and it actually inhibits them. It could stress them out. They have too much of their income going toward their mortgage, and then if their income is going to drop in the future, then it could really stress out the household finances, or it might make someone work longer than they actually want to.
Right.
Yeah.
Right. So when you talk about, I mean, you talked about a down payment and having 20%. I checked earlier today, and the average median home price in San Diego was a little over $700,000. So
Yeah.
20% of $700,000 is $140,000. And the median income in the city of San Diego is somewhere around like 75,000. So, that's like 2 years of not buying anything and just putting all of your income towards your down payment. So what are some strategies that people can use to actually save for a down payment?
Well, the first thing, you hit it on the head, is to actually just save, which most people aren't doing. They're not very good at. 70 to 80% of American households, there's about 130 million American households, and 70 to 80% of them are living paycheck to paycheck. And it's largely due to mismanagement of their finances. Their debt load is too high. Most people aren't very good at managing the money that is coming in. And the 75,000 that you quoted, that's gross income. That's not even taking taxes into account. So of course you'd have to take taxes off that. But I think for some people, outside of San Diego, and I'm sure some of your listeners are outside of San Diego, when the median home prices are much better than that. Maybe you can find a really nice place with land and have everything you want for 250,000, 300,000 somewhere in the Midwest or the South. And obviously, it's San Diego markets and other higher priced real estate markets around the country are in a tougher spot, because it's going to take a while for you to build up a serious down payment for most American families that are making that $60,000, $70,000 household income. So the big thing is just to try to get your other spending down, stay out of other debt. Don't buy the $50,000 Lexus that's going to have the $550 monthly car payment. Set a budget, plan on living below your means, and then having a certain amount that you can sock away on a monthly basis toward this down payment. And 20% is nice because that avoids the mortgage insurance premium. But if someone comes in with 10% or 15%, it's still doable. But in my opinion, I'm opposed to debt, and real estate debt's a little bit different because you do have an asset that's backing it that's hopefully appreciating over time. But the principle holds that the more debt someone has in their financial profile, the riskier their financial profile is. So if you can it's better to come in with a larger down payment than a smaller one. It's just it might postpone someone's plans on when they can actually buy or what they're buying, right? So they might have to make some concessions on what they're buying so that the price to get into it is lower, or maybe they're not going to live downtown San Diego. Maybe they do need to move out to East County or North County or something like that, so that they can make those numbers work better for them. And there might be a need to be a realignment on a time frame. Our culture is not a very good culture when it comes to waiting. We're not a patient culture. We want things now. When we make a decision to buy a new house, we want to buy a new house right now. And the fact of the matter is, that's not always the wisest thing to do. So if you can push it out a few years, based on whatever your financial profile looks like, set a target amount of what you do want to come in with a down payment, and then take the time that's required to save that thing up, and then come in with that cash. Or maybe there's an opportunity to liquidate some investment accounts, or maybe there's some other creative ways that you can finance that down payment, as it makes sense.
Yeah, absolutely. That is really helpful. And I also really appreciate what you said about just like saving and living below your means. I think a lot of times when I work with buyers and sometimes homeowners, a lot of times what they're really thinking is, okay, can I afford, this? I make this amount of money every month, and based on how much money I make every month,
Yeah.
can I afford this amount of debt, as opposed to looking at how much that total debt is. Is it $100,000? Is it $1 million? Is it a $50,000 car payment? Like, how much are you really paying? and how long are you going to be paying that? So that's really a useful piece of advice. It's just like living
Yeah.
below your means.
And the other thing, Franz, too, is you need to be thoughtful of where you're going. What is the personal vision that you have for your family or your household? Because what a lot of people end up doing is they get very excited, maybe in their 20s and 30s, and maybe both, if it's a married couple, maybe both spouses are working, they get the pre-approval and they get the most mortgage they can, that's pursuant to having both of those incomes. And then what happens a few years down the road, they want kids perhaps, and they're like, we can't afford for mama to stop working. And so they painted themselves into a corner basically where now their family planning has to be postponed, or they need to make some sort of adjustment because they weren't thoughtful and they weren't intentional about where they wanted to be down the road, and they ended up buying too much place, and that restricted their options down the road.
Yeah, which is something that I definitely work when I work with buyers and sellers too, depending on the circumstances. But I really say, what are your long-term goals? What are you really looking for? And how does this fit in? I mean, we're not people who are you don't just buy a house and then stop living, right? You still have a life, you have other things, you want kids, you might want a car, you might want to move, you might want to get a new job, whatever. So I really figure out, how does this purchase of a home fit into your greater plan of
Yeah,
what you want your personal life to look like?
yeah. And I think the greatest position going into retirement relative to retirement planning is being completely debt free, including your mortgage. And if your mortgage is paid off and you're a homeowner, then you're still going to have your taxes, you're still going to have your insurance, and if it's a condo or a townhome, you're still going to have your HOA, but you don't have that principal and interest payment. And what I know is that most people, homeowners, regardless of their age, they still carry their mortgage. I heard a statistic that the average 65-year-old still has 23 years left on their mortgage. Okay, so that puts them out to be about 88 years old. They're most likely going to die with that mortgage. So it's hard. It's hard not to tap your equity. It's hard not to like see that asset there and know that, hey, we can access this and pay 4.5 or 5% interest, and we can take that 2-month European trip that we've always dreamed of, and they end up doing it. But what I really like to do, what I counsel my clients in, is setting a schedule to have that mortgage paid off by the time you retire. And it's a balance, but if you've got some time, if you've got the cash flow, then I think that's a really worthy endeavor to try to be completely debt free when you retire, because you'll have so much more freedom. And nobody has ever complained to me about being debt free. I'll say that much.
Yeah, definitely. Um, and I mean, I heard you talk about sort of having an asset like a house, and you see, again, not uncommon for somebody to have like $1 million house in San Diego, and they're like, I have $1 million here. I want access to that $1 million. Are there some like healthy options? I remember another episode I talked to Andy McMullen, who really talked about like, okay, lazy equity, can you make your money work for you? So can you take out $800,000? You have a say $3,000 payment on that $800,000, but you put it in a sort of cash flowing investment that generates you say $6,000 a month. So then you have a net $3,000 a month. Do you have any thoughts on, using your equity that way?
Well, I would say, I mean, my first initial thought is take caution and really find out why you want to tap into this equity. And is this the wise thing to do? Because there have been a lot of people that have tapped into their equity, and then the market's correct, or their financial situation changes, or their family situation changes, and now they're up a creek without a paddle. My memory goes back, I've been doing this for 16 years, and I remember during the Great Recession, which started toward the end of 2007, it's like October of 2007 through the first part of 2009 through like March of 2009, the stock market was down about 50%. And then here in San Diego, the real estate market during the Great Recession was also down about 50%. And there were a lot of people that thought they were making wise decisions in 2005 and 2006 and 2007. And they really ended up hurting themselves when things changed and when the market started falling, both real estate market and the investment market. And so if you, in your example, if you had $1 million equity place and you took out $800,000, which would be a lot, and suddenly the market did fall 50%, so your $1 million place goes down to $500,000, and you still have 800,000, and then you say, well, what happened to the other 800,000? Well, if it was in investment markets in a time like that, then those would have been down 50% too. So now you still owe on this 800, you still owe your monthly payment on this 800,000, but your net worth has decreased significantly, and it just didn't work out. So I would just say take caution, understand why you're doing it, make sure that it makes economic sense, speak to wise counsel, like here's what I'm thinking, speak to a real estate person, speak to a financial planner. I have seen where it can make sense to tap into equity to try to, for that arbitrage opportunity, to take that money out, pay the 4.5% or 5% on a home equity line of credit or a home equity loan, and then do something else with it to try to make more money off of that money. I have a client right now who is considering taking out $60,000 of equity to do a renovation and create an ADU in their place, which is basically another tiny little apartment inside their home. And we looked at the numbers. Actually, this was just yesterday. We looked at the numbers, and it was going to be like a $450 payment for them off that $60,000 home equity line. And I asked her, how much rent do you think you can get for this apartment in your area? And she said about $1,500. So other factors aside, the delta on that is about $1,000. So it's, I think in a situation like that, it can make sense. And where they're at financially, that is prudent, and they have so much more equity than that 60,000 that even if there was a reasonable or substantial decline in the valuations of their properties, it's going to take a lot for them to get in trouble. So I had no problem in that case. Is that considered lazy equity? Yeah, I mean, if you could pull some money out of that and have it make financial sense based on some prudent alternative, then it's worth considering.
Absolutely. Well, I definitely appreciate that advice. So we've kind of talked about a lot of different things. We talked about how to save for a down payment. We talked about a little bit about lazy equity. We talked about planning and making sure that you're able to, if your circumstances change, you'll be able to afford your payments. I guess my last question is just about unexpected expenses. So I don't know how true this statistic is today, but I remember reading a statistic like maybe 5 or 6 years ago that said a person in the US who got an unexpected $500 expense would not be able to pay it, like some really large number of people. And I can tell you as a homeowner, a $500 unexpected expense is nothing. So what should people do so that, when they need a $15,000 roof, they're able to pay for a $15,000 roof? Like, what can people do to just deal with the unexpected expenses that just come with homeownership?
Yeah, well, I mean, so insurance can take care of some of that. So making sure that you got the right insurance. So talk to your property and casualty insurance agent. If you don't have a good one, find a reputable one, a person of integrity, and actually go through that stuff with them and see how much exposure to risk you actually have. There's a lot of different types of insurances out there that can plan for these types of unexpected events. Save, for me, when you think about emergency funds, most financial planners talk about having 3 to 6 or 9 or 12 months worth of expenses that's sitting in a checking account or a savings account or a money market account that's just there waiting for something to happen. And how much cash you should have in your emergency fund is relative to your situation and the amount of risk that you have. If you're a married couple and let's say John works for the government and Jane is a tenured professor, probably not a lot of risk in that household, probably decent incomes. So they might be more towards that 3-month mark. Let's say that in another situation, a person is single, they're in sales, and their income is highly volatile. In some months, they might not make much money at all. Well, in that case, you can probably stretch more towards that 6 or 9 or 12 months worth of funds in there in the emergency fund. And that money is sitting there waiting for the unexpected, for all the ifs in life. And so I think, it's probably a balance between insurance and having cash on the side, waiting for something like that to happen. And I know that you might be thinking that bank accounts aren't paying anything. I can't even get 1% right now at the bank. That's true, but that money is not really there for you to be making 9 or 10 or 11%. That money is there as essentially a cash policy, an insurance policy for risk that's effectively self-insured for the ifs in life, the unexpected. And so I think that's really wise to have as a homeowner, because you're right, Frantz. I mean, things do come up. The roofs do need, and again, you have to come up with a deductible for the insurance policy that's going to cover some of those claims. But there will be some things that, you're going to have $2,000 or $3,000 or $4,000 expense. And if you have cash sitting on the sideline waiting for those things to come up, that's a good situation to be in. And the statistic that you quoted earlier is right on the money. The one that I've got memorized is about half of American households, if they had $1,000 expense, they don't have the cash to pay for it. So we are not a culture where the masses are very good at saving money. Like I said earlier, 70 to 80% of American households are living paycheck to paycheck. So for most American households, they are one financial emergency away from a disaster. And so you can be that minority in our country that gets things under control, that can save some money and have some reserves available for when those unexpected things do happen.
Yes. Well, Jason, thank you so much for being with us. I really appreciated your very thoughtful and well-reasoned answers to all of my questions. And my last question that I ask all of my guests is, if somebody watched this and they're like, I think Jason is awesome, and I think Jason is as awesome as I think, as Frantz thinks he is, how can they get a hold of you?
Yeah, I appreciate the friendly endorsement. Thank you. So you can go to opendoor-financial.com, opendoor-financial.com, and there's a contact me button there, and be happy to talk to anybody.
Awesome.
Or reach out
It's
to
open.
Frantz, and Frantz can connect.
That is true. I am nothing if not the spoke on this weird tangled wheel web of people that I know. And you said open Jason Batt, and it's opendoor-financial.com, which I
Yep.
stuck in the comments for anybody who's watching. And I want to say thank you so much for being with us. I really, really, really appreciate everything that you provided to us today. And I look forward to talking to you and also chatting with another guest. Not next week, but the week after. Next week, again, I have like a weird scheduling conflict on Tuesday, so it'll either be on a different day. But what I will do is I will post a really awesome exclusive interview that I did with the California Lawyers Association with the MacArthur Grant recipient for 2020, who is a really, really knowledgeable law professor, or one of the recipients of the MacArthur Grant. He is a really knowledgeable law professor, and he talks about some interesting work that he has done around homeownership and private property rights and maintaining familial ownership of property. So thank you all for being here, and I will see you all in 2 weeks. Bye-bye.
Bye, everybody. Thanks,
Bye.
Frantz.
You're welcome.